India's retail investors have an all-new investment class, Specialized Investment Funds, launched by SEBI from 1st April 2025. These funds are designed to bridge the gap between mutual funds and portfolio management services and alternative investment funds. But what exactly are specialized investment funds? How are they different? And should you consider them for your portfolio? Stay with me because by the end of this video, you'll know whether specialized investment funds are meant for you, or if you're better off sticking with good old mutual funds. Here's the simplified picture of specialized investment funds, a brand new investment class introduced by SEBI. They're designed to bridge the gap between mutual funds, which are mass retail friendly, and portfolio management service and alternative investment service, which are for the ultra-rich. Entry ticket, minimum investment is 10 lakh rupee. This makes them accessible to affluent retail investors. Why they're different, mutual funds stick to relatively simple, diversified strategies. SIF allow fund managers to use long-short strategies, derivatives, and flexible sector bets. PMS or AIF offer even more freedom, but require 50 lakh rupee to 1 crore rupee minimum. Strategies available. SEBI has permitted 7 strategies. 1. Equity long-short. The equity portfolio can go both long and short. For your information, the regular mutual fund can go only long position, where the mutual fund are only allowed to buy an asset or stock and hold it to gain returns when the stocks goes up. But in this fund, up to 25% of the portfolio can also be short without holding an asset. A short positions is when you first sell a stock without owning it and makes money when the market goes down. It's called short selling in derivatives terms. Regulator allows this particular fund to go 75% long and 25% short, which means going forward the fund house managers can make money both ways when the markets are going up as well as when the markets goes down. So that's why a long-short fund is a smart investment, a higher risk but a smarter investment. 2. Equity X. Top 100 long-short, which means this fund will avoid top 100 funds and focused on stock outside the top 100 market cap and go on a long-short positions. 3. Sector rotation long-short, which means SEBI allows the fund to manage up to 4 sectors on a rotation basis. So this gives an active opportunity for the fund manager to invest in those sectors that are performing and also short sectors that they believe will underperform. These are the 3 equity funds that SEBI has given approval to launch. In the debt category, one can again take long-short positions. These debt-oriented strategies is one of first kind, a theme we have never experienced in investing so far. 4. Debt long-short. Like the equity long-short fund, the fund manager can take both long and short positions. 5. Sectoral debt long-short. The fund manager will also have the flexibility to invest into different sectors to make money. The last category is the hybrid strategies. 6. Active asset allocation long-short fund. This is the most interesting fund of all, and I personally love the concept, which means dynamic allocation across all asset classes between equity, debt, and commodities at various points and time. The fund manager can move the investment from one asset to another as per the market scenario. The flexibility in this fund is something to look forward to. 7. Hybrid long-short. Similarly, this hybrid fund will have the balanced exposure to equity and debt with short positions. Risk and return. Higher potential returns than mutual funds, but also higher risk and volatility. Not suitable for beginners. Better for seasoned investors who understand derivatives and concentrated bets. This is the kind of investment investors need to thoroughly do their homework before making any investment. The risk and liquidity is much different than our simple mutual fund. Risk and liquidity factor. Let's dive deeper. These products are high risk Therefore, SEBI has mandated 5 categories of risk to be displayed on each of these funds. So any funds that is launched here must fall within these 5 risk parameters that are already predefined, so that investors can look at it and understand what level of risk they are taking on this product. On redemption and liquidity, these are going to be totally different from mutual fund. The mutual funds industry are highly liquid, and therefore daily liquidity is possible. But in case of SIF, the liquidity is going to be less frequent, may once or twice a week, or even less frequent redemption. What this means is that the fund manager aren't so much in stress to liquidate every single day on this product. So it gives more time given that the volume is much larger and it's a new product. So SEBI has carefully thought and lay out since it's a much larger bite. In fact, there's also a clause that says, as per the asset management company and the offer document, which sound tricky as the fund house can actually give a much longer notice period of maybe 15 or 20 days and say if you want to redeem your investment after giving your request, and it can even take 15 or 20 days for the fund house to redeem your investment. I wonder, in a fast world, do our Gen Z generation have the patience to wait? You can answer that for yourself and comment below. For everyday small investors, still stick to mutual funds and SIP. For affluent retail investors, specialized investment funds could open a middle ground, without needing crore like AIF. What do you think are SIF the future of smart investing in India, or will investors still prefer the comfort of mutual funds? Drop your thoughts in the comments below. Subscribe to the channel for more informative content like this.